In September 2022, the British pound fell so fast that currency traders thought their screens were broken. Not a slow decline, not a gradual weakening, a free fall. In less than 2 hours, the pound dropped to its lowest level against the dollar in history. Pension funds started collapsing. The Bank of England had to step in with emergency billions just to stop the entire system from imploding. And here's the strange part. 3 months earlier, everything looked fine. The UK wasn't some fragile economy on the edge. It was one of the world's largest financial centers. Stable institutions, deep markets, centuries of credibility. So, what happened? The answer isn't what you think, and once you see it, you'll start noticing the same pattern everywhere. Venezuela, Zimbabwe, Argentina, the Weimar Republic, even Rome. Before every currency collapse, the same sequence plays out, the same warning sign flashes. And almost nobody pays attention until it's too late. Here's why this matters right now. Since 2020, central banks around the world have created more money than in the previous 2 centuries combined. The US alone printed 40% of all dollars in existence in just 18 months. And everyone keeps asking the same question. When does this break? The answer is already written. We've seen this movie before, many times. In different countries, different decades, different political systems, but the script never changes. The thing is, currencies don't collapse because of printing money. That sounds wrong. I know, but stay with me. Printing money is just a symptom. It's what happens after the real problem starts. The actual trigger is something much more specific, much more insidious. And it's happening in slow motion right now in ways most people don't recognize. To understand it, you need to see how the machine actually works. Not the textbook version, the real version. The one where incentives, desperation, and math collide in predictable ways. Every modern currency operates on the same basic deal. The government needs to spend money, more than it collects in taxes. This gap is called a deficit. Nothing unusual about that. Most governments run deficits most of the time. To cover the gap, they borrow. They issue bonds, IOUs, essentially. Promises to pay you back with interest. Who buys these bonds? Pension funds. Foreign governments, banks, individual investors. Anyone who believes they'll get their money back. This system works beautifully as long as one thing remains true. People trust they'll be repaid in currency that holds its value. But here's where it gets interesting. Governments have a special superpower that you and I don't have. They control the central bank, and the central bank controls the printing press. Now, in theory, the central bank is independent. It makes decisions based on economic data, not political pressure. That's the story. Anyway, in reality, there's a moment in every currency crisis where this independence evaporates. It happens when the government's debts become too large to refinance through normal borrowing. When bond buyers start demanding higher interest rates because they're getting nervous. When the cost of servicing the debt starts eating up more and more of the budget. At this point, the government faces an impossible choice. Option 1. Cut spending dramatically, fire government workers, slash benefits, trigger a recession, collapse your approval ratings. Option 2. Raise taxes significantly, same political suicide, different method. Option 3. Default on your debts, destroy your credibility, get locked out of global markets for a generation. Or Option 4. The central bank could just buy the bonds itself, create new money, purchase the government's debt directly or indirectly through market operations. This is called monetary financing. Debt monetization, printing money to pay bills. And this is the moment. This is the thing that always happens first. When the central bank starts buying government debt in meaningful quantities, a clock starts ticking. At first, nothing seems to change. The economy might even look healthier. Government spending continues. Markets stay liquid. Crisis averted. But underneath, the math shifts. See, money is only valuable because it's scarce relative to the goods and services you can buy with it. When you increase the money supply faster than the economy grows, each unit of currency becomes worth less. This doesn't happen instantly. There's a lag, months, sometimes years. The new money enters the system through specific channels first: government contracts, welfare payments, public sector wages. It flows into asset markets before it hits consumer prices. So, for a while, people with assets get richer. Stock markets rise, real estate booms. Everything looks great if you own things. But the people who live on wages or fixed incomes start to feel it first. Groceries cost more, rent goes up. Their purchasing power erodes while the official inflation numbers still look manageable. And here's the trap. Once this process starts, it's almost impossible to stop, because stopping means letting interest rates rise to their natural level. It means letting the government's borrowing costs spike. It means forcing the political system to make those impossible choices we talked about earlier. So instead, they accelerate. The central bank buys more bonds, creates more money, tries to keep the system afloat just a little longer. Zimbabwe did this. Venezuela did this. Argentina has done this repeatedly, but so did the Weimar Republic, one of the most industrialized, sophisticated economies of its time. In 1919, German government debt was manageable. By 1921, the Reichsbank was buying government bonds at an accelerating rate. By 1923, people were using banknotes as wallpaper because the paper was worth more than the currency printed on it. For years, that's how fast it can unravel once the pattern starts. Now, you might be thinking, but wait, the U.S. Federal Reserve has been buying trillions in government bonds since 2008. Japan's been doing it even longer. Why haven't those currencies collapsed? Good question. The answer reveals something important about how this pattern actually plays out in reserve currencies. When your currency is used globally for trade and finance, you have a massive buffer. Demand for dollars or yen comes from outside your economy. Other countries need your currency to buy oil, to settle international transactions, to hold as reserves. This external demand absorbs a lot of the new money creation before it translates into domestic inflation. It's like having a release valve, but that valve is infinite, and it doesn't stay open forever. When foreign holders start losing confidence, when they begin diversifying away from your currency, when they stop automatically recycling their trade surpluses into your bonds, that's when the buffer disappears, and that process is happening right now. China and Russia have been reducing their dollar holdings for years. The share of global reserves held in dollars has been quietly declining. More trade is being settled in other currencies. It's not dramatic. It's not a crisis yet, but it's the same pattern, just playing out in slow motion because of the enormous scale of the dollar system. The UK found out how fast this can shift. Remember that pound crisis in 2022. Here's what actually triggered it. The new government announced massive unfunded tax cuts. Borrowing was going to spike, and bond markets immediately asked, who's going to buy all this new debt? When the answer wasn't clear, yields jumped. Pension funds that had leveraged positions got margin calls. The selling accelerated. Within hours, the Bank of England had to step in and buy government bonds. Emergency monetary financing. The exact pattern we've been talking about. The pound stabilized only after the government reversed course completely. New prime minister, new finance minister, tax cuts scrapped. But here's what's unsettling. The UK is a relatively small economy with a currency that's not systemically important to global finance. What happens when this pattern plays out in a reserve currency where there's no higher authority to step in? Let's zoom out to the bigger picture. U.S. government debt is now larger than the entire economy. Debt to GDP over 100%. Interest payments alone are approaching $1 trillion a year. Japan's debt is over 250% of GDP. The Bank of Japan owns nearly half of all government bonds. The European Central Bank owns trillions in sovereign debt from member countries. This isn't fringe behavior anymore. It's the baseline. Now, here's the math problem that keeps financial historians awake at night. As populations age, governments need to spend more on pensions and healthcare. As geopolitical tensions rise, defense spending increases. As infrastructure ages, maintenance costs compound. Meanwhile, economic growth in developed countries is slowing. Productivity gains are harder to find. The tax base isn't expanding fast enough to cover the promises that have been made. So, the gap between spending and revenue keeps widening, and bond markets are getting nervous. You can see it in the yields, in the volatility, in how quickly sentiment can shift when a government announces new borrowing. Central banks are trapped between two terrible options: let rates rise and crush the economy under debt service costs, or keep rates low and watch inflation erode everything. They've been choosing the second option, but inflation has a way of forcing the issue. When people lose faith in the currency's future value, they change their behavior. They spend faster, they demand higher wages. They buy hard assets, they move money abroad. This accelerates the inflation itself. It becomes a self-fulfilling prophecy. And once that psychology shifts, once the collective belief in the currency's stability cracks, reversing it requires immense pain. You have to jack interest rates up so high that you destroy demand, trigger a deep recession, prove to markets that you're willing to choose deflation over debasement. Paul Volcker did this in the early 1980s, raised rates above 15%, caused the worst recession since the Great Depression. But it worked. It broke the inflation psychology, restored confidence in the dollar. The question is, does any central bank today have the political capital to do something that extreme? Or will they keep printing until the pattern completes itself? Here's the darkly funny part about all of this. The pattern is completely visible. Historians have documented it. Economists have studied it. The playbook is sitting right there in libraries and databases. And yet it keeps happening. Why? Because the political incentives are too strong. No elected official wants to be the one who cuts spending or raises taxes enough to actually fix the structural problem. No central banker wants to trigger a recession on their watch. So everyone kicks the can down the road. Print a little more, borrow a little more, keep the music playing a little longer. The truly bizarre thing is that markets go along with it. Even though everyone knows how this ends, money keeps flowing into government bonds. Yields stay low. The system perpetuates itself until suddenly it doesn't. That's what makes these collapses so shocking when they finally arrive. All the information was available. All the warning signs were flashing, but collective denial, a powerful force. People assume that because something has worked for a long time, it will keep working, that somehow this time is different, that modern financial engineering has solved problems that destroyed currencies for thousands of years. It hasn't. The math doesn't care about sophistication. It doesn't care about good intentions or political necessity. At some point, the equation balances, one way or another. So where does this leave us? The pattern is playing out again, slower this time because of the scale, more complex because of the global financial system, but the same fundamental sequence. Governments spending more than they collect, deficits growing, central banks buying bonds to keep the machine running, inflation appearing first in assets, then in essentials, confidence slowly eroding at the margins. The question isn't whether the pattern exists. The historical record is clear. The question is timing. How long can reserve currencies defer the resolution? How much can external demand buffer before it breaks? And maybe the more uncomfortable question, what comes after? Because here's the thing about currency collapses. They don't happen in isolation. They cascade through the system. Trade breaks down. Supply chains fragment. Social contracts strain. We like to think we're insulated from this, that it only happens to other countries, unstable places, poorly managed economies. But Rome thought that too. The pattern doesn't discriminate. It just completes itself. And that first step, that moment when the central bank starts printing money to buy government debt in earnest, that's already happened. The clock is ticking. We just don't know how much time is left.